RWA, real-world assets, explained, everything you need to understand. In recent years, the world of crypto has been dominated by digital native assets, tokens with no real-world backing, existing solely on the blockchain. But as the industry matures, a new trend is rapidly gaining momentum: real-world assets, or RWAs. These are tokenized versions of traditional financial and physical assets, like real estate, government bonds, stocks, invoices, commodities, and even intellectual property, brought onto the blockchain to unlock faster, cheaper, and more transparent financial infrastructure. And in 2025, RWAs are no longer a fringe idea, they are becoming the bridge between traditional finance and decentralized finance. Before we begin, an important message: crypto assets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. At its core, the concept of RWAs is simple. It's about taking something that exists in the real world, like a commercial building, a car lease, or a share of stock, and representing ownership or rights to it digitally on a blockchain. The tokenized version of that asset can then be traded, borrowed against, used in smart contracts, or held in a crypto wallet, just like any other token. But what makes RWAs so powerful isn't just the ability to digitize things, it's the ability to make them programmable, borderless, and liquid in ways that were previously impossible. Traditionally, real-world assets are locked behind layers of bureaucracy, paperwork, middlemen, and regulatory hurdles. Transferring ownership of a bond might take days, require wet signatures, or cost a fortune in fees. But on a blockchain, once an asset is tokenized, it can move instantly, settle automatically, and interact with decentralized applications. This opens up enormous potential for efficiency, and a massive opportunity for unlocking value. Tokenizing real-world assets also breaks down barriers that have historically excluded smaller investors. Fractional ownership is one of the most exciting aspects of RWAs. Instead of needing $1 million to buy a building, you could own a $100 token that represents a fraction of that building's revenue. This isn't just theoretical. Platforms are already offering fractional exposure to US Treasuries, commercial real estate, invoice financing, and even art or music royalties. The rise of RWAs is being driven by both crypto-native platforms and traditional financial institutions. On the one hand, DeFi protocols are looking to expand beyond volatile crypto assets and integrate more stable, yield-generating real-world instruments. On the other, banks, asset managers, and governments are realizing that blockchain can offer significant improvements to efficiency, compliance, and accessibility. The result is a convergence: TradFi meets DeFi, and RWAs are the handshake. Ethereum is the primary home for RWA innovation today. Its smart contract flexibility, developer base, and widespread adoption make it the go-to chain for tokenization. But layer 2s like Polygon, Base, and Optimism are gaining traction too, offering faster and cheaper transactions that make RWA use cases more viable at scale. Meanwhile, dedicated platforms like Centrifuge, Ondo Finance, Polymesh, Maple Finance, and Relio are emerging as specialized infrastructure for RWA issuance, securitization, and liquidity. Let's take a closer look at the most commonly tokenized real-world assets in 2025. First, government bonds, particularly US Treasuries, have become a go-to for DeFi protocols seeking low-risk yield. Projects like Ondo Finance and Superstate have made tokenized treasuries accessible on-chain, allowing users to hold dollar-denominated yield-bearing assets with full transparency and instant settlement. This has been a game-changer for stablecoin diversification and on-chain savings products. Real estate is another major RWA category. Platforms like Railed, Tangible, and Matrix Stock are tokenizing income-producing properties around the world, allowing crypto investors to gain exposure to rental yields, commercial leases, or property appreciation, all without the hassles of property management. Token holders receive revenue distributions automatically, and liquidity is handled via secondary marketplaces. Commodities like gold, silver, and oil are also seeing increased tokenization. Projects like Paxos Gold and Tether Gold offer fully backed tokens redeemable for physical metal. These assets combine the trust of real-world value with the accessibility of crypto. For investors in emerging markets or underbanked regions, this provides a way to hedge against inflation or currency risk using nothing more than a smartphone and a wallet app. Another fast-growing RWA sector is trade finance and invoice factoring. Businesses can tokenize outstanding invoices or receivables, and investors can purchase those claims to earn yield. Projects like Centrifuge are pioneering this space, connecting SMEs with decentralized capital while generating stable, real-world cash flows for DeFi users. This creates a powerful feedback loop, real economic activity feeding DeFi, and DeFi capital supporting real businesses. RWAs are also making waves in the art and collectibles world. Tokenization of artwork, music royalties, and luxury goods allows for fractional ownership, global transferability, and embedded royalties, creating new revenue streams for creators while giving investors exposure to culturally significant or historically valuable assets. For example, platforms like 12 on 12 and Another Block let users invest in music rights or tokenized album royalties, receiving streaming income over time. Similarly, digital certificates tied to physical artwork can track provenance, ownership, and resale in a completely transparent way. As exciting as the technology is, it's the market demand that's truly driving RWA growth in 2025. With traditional yields remaining low in many regions and inflation still a concern, crypto investors are hungry for stable, real-world returns. Meanwhile, traditional institutions are looking for ways to modernize, reduce costs, and broaden their investor base. RWAs serve both sides. They allow DeFi users to earn yield from real-world instruments and allow institutions to tap into on-chain liquidity and settlement. Another advantage of RWAs is composability, the ability for tokenized assets to interact with DeFi protocols like money Legos. A tokenized bond, for example, can be used as collateral on Aave, swapped on Uniswap, insured on Nexus Mutual, and staked in an automated vault, all via smart contracts. This seamless interoperability creates entirely new financial instruments that can operate 24/7, across borders, without intermediaries. But RWA adoption doesn't come without challenges. The biggest obstacle remains regulation. Tokenizing real-world assets involves bridging physical legal systems and blockchain logic, a task that requires careful structuring, clear compliance processes, and often licensed custodians or regulated intermediaries. This is why many RWA projects are either registered investment vehicles or partner with regulated firms to ensure asset backing, investor protections, and legal enforceability. Another challenge is transparency and trust. While blockchain is inherently transparent, the off-chain elements of RWA, like property ownership, legal claims, or asset custody, require trust in third parties. If a token says it's backed by a warehouse full of goods, investors need assurance that those goods actually exist, are insured, and are not double-counted. This is where third-party auditors, oracles, and real-time attestation providers come in. Chainlink, for example, is increasingly used to bridge real-world data, such as asset prices or legal status, into smart contracts. Liquidity is also a work in progress. Many tokenized assets are not yet widely traded, and secondary markets are still maturing. Unlike Bitcoin or ETH, RWAs may have restrictions on who can buy or sell, especially in jurisdictions with strict securities laws. Some platforms have introduced KYC-gated liquidity pools or allow trading only within approved jurisdictions. While this limits composability, it also ensures legal compliance, a necessary step in bringing institutional capital on-chain. Despite these hurdles, the momentum behind RWAs in 2025 is undeniable. In fact, some analysts believe that RWAs will eventually become a larger part of the crypto economy than native tokens. The total addressable market is enormous. The global bond market alone exceeds $130 trillion, real estate tops $300 trillion, and commodities and art represent trillions more. Even tokenizing a small fraction of these markets could transform crypto into the infrastructure layer for the entire global economy. There's also an ideological shift taking place. In the early days of crypto, many saw traditional assets as the enemy, part of a broken system that blockchain aimed to replace. But today, there's a growing realization that bridging old and new systems is not only possible but powerful. RWAs don't dilute the vision of crypto, they expand it. By bringing real assets onto open infrastructure, RWAs democratize access, increase efficiency, and give users unprecedented control. One of the key reasons RWAs are gaining traction now, and not 5 years ago, is the maturity of supporting infrastructure. Smart contract platforms have become more robust. Oracles have improved. Stablecoins are widely adopted. Regulatory clarity, though still evolving, is slowly being established in major markets like the US, Europe, and Asia. All these building blocks are critical for RWAs to function securely and legally at scale. Additionally, there's been a notable rise in institutions entering the RWA space. Major banks, asset managers, and custodians are exploring or piloting tokenization strategies. In 2024, BlackRock launched its tokenized asset fund, BUIDL, on Ethereum, using it to hold US Treasuries and make them available to qualified investors in on-chain form. JP Morgan continues to expand its Onyx platform. Goldman Sachs is investing in blockchain-native settlement solutions. This isn't just hype, it's a clear sign that institutions are preparing for a tokenized future. Governments are also taking notice. Countries like Singapore, Switzerland, and the UAE are becoming hubs for regulated tokenization experiments. Hong Kong and the UK are racing to create legal frameworks for digital securities. And some central banks are now exploring how tokenized RWAs might interact with central bank digital currencies, CBDCs, to create programmable money with real asset backing. As the ecosystem expands, we're seeing the emergence of RWA native DeFi protocols, platforms built specifically to handle the unique needs of tokenized real-world assets. These protocols integrate compliance checks, off-chain data feeds, and real-world underwriting. Examples include: Centrifuge tokenizes real-world credit, such as invoices, supply chain receivables, and inventory financing, and connects them to DeFi liquidity pools. Ondo offers tokenized exposure to US Treasuries and corporate bonds, and is building institutional-grade RWA vaults. Maple Finance, focused on under-collateralized lending, now expanding into RWA debt products with institutional partners. Polymesh, a Layer 1 blockchain purpose-built for regulated digital securities and RWA tokenization. These platforms aim to combine the speed and flexibility of DeFi with the regulatory compliance and risk management of traditional finance. It's not just about making money faster, it's about making money systems more fair, open, and accessible. RWAs are also catalyzing the next wave of innovation in DeFi primitives. Yield-bearing stablecoins like STR or USDM are increasingly backed by tokenized RWAs. New forms of collateral, like tokenized real estate or bonds, are entering lending protocols. And insurance platforms are using tokenized risk pools based on real-world asset exposure. Even perpetual trading platforms are exploring synthetic assets derived from tokenized equities or commodities. Interoperability between blockchains is another area of focus. Many RWA issuers are exploring multi-chain or omni-chain deployments. For example, an RWA token might be minted on Ethereum but bridged to Polygon, Arbitrum, or even Solana to tap into different DeFi ecosystems. This introduces new challenges, such as custody, bridging security, and governance, but also unlocks more liquidity and user access. Still, the RWA revolution isn't about flipping a switch, it's about building trust. For traditional investors to embrace tokenized assets, there needs to be clear legal protection, consistent reporting, reputable custodians, and reliable on-chain/off-chain connections. Projects that prioritize transparency, licensing, and audits are gaining market share, while anonymous or poorly structured offerings are being left behind. What also makes RWAs compelling is their ability to bring stability to DeFi ecosystems that have historically been dominated by volatility. During crypto bear markets, protocols built solely on crypto-native collateral often struggle as token prices plummet. But by incorporating real-world yield-bearing assets, protocols can create more resilient financial systems, ones that are grounded in economic reality rather than pure speculation. This diversification of collateral types is critical for long-term sustainability and institutional adoption. We're also witnessing an interesting cultural shift in the DeFi community. The early days of crypto were filled with phrases like "be your own bank" and "burn the system down." But with the rise of RWAs, a more collaborative narrative is emerging, one focused on coexistence, integration, and infrastructure. It's not about abandoning decentralization, but about upgrading the global financial system with decentralized principles. In this new paradigm, blockchains serve as rails, not revolutions, tools to make finance smarter, faster, and more equitable. Another aspect worth exploring is the role of oracles in the RWA stack. Because RWAs rely on off-chain data, like property appraisals, invoice validity, or bond prices, secure and reliable oracles are essential. Chainlink, Pyth Network, and API3 are at the forefront of providing real-world data to smart contracts, including proof of reserves, asset pricing, and audit verifications. These systems serve as the connective tissue between the physical and digital worlds, enabling automation, transparency, and trust in RWA protocols. And then there's the social impact potential of RWAs. In emerging economies, tokenizing local assets, like farmland, microloans, or solar panel projects, could unlock access to global capital for entrepreneurs and communities previously excluded from traditional banking systems. By removing middlemen and creating liquid markets, RWAs can democratize access to funding, increase efficiency in capital deployment, and promote more inclusive growth. The benefits extend to ESG investing as well. By tokenizing carbon credits, renewable energy certificates, or sustainable development bonds, investors can gain transparent, traceable access to impact assets. Some platforms are now offering tokenized green bonds or regenerative finance, ReFi, pools, where every transaction supports environmental or social goals. This fusion of crypto technology with mission-driven finance could reshape how capital flows in the 21st century. Of course, none of this will happen without robust legal and custodial frameworks. Tokenizing real-world assets is not just a technical process, it's also a legal one. Ownership must be enforceable in court. Custodians must be regulated and insured. Smart contracts must comply with local laws. That's why many RWA platforms work with licensed trustees, broker-dealers, and transfer agents to ensure asset backing and legal recourse. Even the token design itself must be considered. Some RWAs are issued as ERC20 tokens with compliance restrictions. Others use security token standards like ERC 1400 or frameworks like the Tokenized Asset Coalition, which promote best practices around permissions, identity, and disclosures. The choice of token standard can impact everything from composability to liquidity to regulatory status. Despite these complexities, tokenization offers huge advantages over legacy systems. It reduces paperwork, eliminates settlement delays, increases auditability, and dramatically cuts costs. A real estate transfer that once took weeks and thousands in fees can now be done in minutes, with an immutable audit trail, 24/7 access, and programmable income distribution. It's not just faster, it's smarter. RWA tokenization is also encouraging a rethinking of what it means to be an investor. In the traditional world, investment opportunities are often limited by geography, accreditation rules, and gatekeepers. But with RWAs on the blockchain, access becomes global. A student in Kenya could invest in a US Treasury-backed token. A retiree in Brazil could hold a fraction of a London apartment. The walls that once confined capital to the elite are slowly being torn down, replaced by open, inclusive financial architecture. That said, scalability is still a question. For RWAs to truly go mainstream, the infrastructure must support millions, or even billions, of users and transactions. This is where Ethereum's Layer 2s come into play. Networks like Arbitrum, Optimism, and Base offer faster, cheaper transactions while inheriting Ethereum's security. Rollups, zero-knowledge proofs, and account abstraction are advancing rapidly, making it feasible to onboard real-world institutions, legal entities, and retail users without sacrificing UX or decentralization. One fascinating trend is the emergence of RWA-backed stablecoins. Instead of relying on reserves like USDT or USDC, newer stablecoins are backed by tokenized T-bills or corporate debt. This adds a layer of transparency and yield to stablecoins, potentially transforming them from passive dollar proxies into yield-generating instruments. Platforms like Mountain Protocol, USDM, and Ethena, SUSD, are pioneering this model, appealing to both DeFi users and risk-averse investors. There's also a narrative shift around national security and geopolitical strategy. Governments are beginning to view RWA tokenization as a tool for maintaining currency strength and global financial influence. Imagine a digital bond issued by the US Treasury on a public blockchain, instantly accessible worldwide, denominated in USD, and settled in seconds. This could entrench the dollar's dominance in the digital age while countering the rise of private or non-dollar-backed financial rails. Yet there are philosophical debates, too. Some critics argue that bringing real-world assets onto the blockchain introduces centralization risks. Others worry about censorship, gatekeeping, or surveillance. These concerns are valid, and they underscore the need for privacy-preserving technologies, open standards, and public governance frameworks. The goal isn't to replace one centralized system with another, but to create systems that are auditable, fair, and user-controlled. So where do we go from here? The next few years will likely be defined by infrastructure refinement, regulatory clarity, and ecosystem growth. We'll see more RWA-native blockchains, better identity systems, smoother fiat on-ramps, and improved legal tooling. Institutions will continue experimenting. Retail users will gain easier access. And eventually, tokenization will simply become the default way assets are issued, traded, and settled. At that point, RWAs will no longer be a niche category within crypto, they'll become part of everyday finance. Just like email replaced fax machines, tokenized assets will replace paper contracts. They'll live in your wallet, move across chains, interact with AI agents, and be governed by code, but backed by real-world value. Crypto will no longer be seen as a parallel economy, but as the foundational infrastructure for global finance. The lines between digital and physical will blur. And RWAs will sit at the center of it all, not as a trend, but as a transformation. Real-world assets, or RWAs, represent a monumental shift in how we think about ownership, finance, and access. They're not just about putting assets on the blockchain, they're about unlocking the full potential of blockchain to serve real people, real economies, and real outcomes. From tokenized government bonds to real estate, from fractional music royalties to trade invoices, the tokenization movement is making financial markets faster, fairer, and more open. By blending the reliability of real-world value with the power of decentralized infrastructure, RWAs are giving rise to an entirely new asset class, one that is borderless, programmable, transparent, and liquid. This new financial frontier isn't reserved for hedge funds or institutions, it's being built for everyone. And while the challenges are real, legal, technical, and cultural, the momentum is stronger than ever. In a few short years, we may not even use the term RWAs anymore, because all assets will be real, digital, and tokenized by default. The convergence of traditional finance and blockchain isn't a maybe, it's happening now. And those who understand it early will be best positioned to navigate, invest in, and benefit from the tokenized economy of tomorrow. Subscribe to CryptoPulse for deep dives, tutorials, and objective insights into crypto's biggest trends.